Hi, I wanted to, we're going to go through the information that we presented this afternoon. I know we had some folks with either link issues or connection issues, and this will actually be better than a recording of the webinar because I'll just be talking to the folks on the recording. And we'll also be able to economize and probably make this a little quicker for you to get the information as well. So if you're listening to this now, we want to say welcome. We appreciate you checking in with Deal and Associates. You may know of us from FHA or some of the other areas that we work in. And we designed this FHA Updates webinar because there is so much happening with FHA right now. It's really amazing, an incredible amount of changes. Some of these changes have been things that lenders have been calling on for a long time. Some of these have been things that FHA, I think, has realized the need for a long time, and many of them are major changes. And there's a lot of upside to the changes. So the intent of today's program was really to walk through some of those changes. So why don't we go ahead and begin? You may know of me, you may know of Deal. If you haven't met me before, this is nice to meet you, and I certainly appreciate you joining us. The short version of what you see on the screen is that my lending experience was fortunate enough to be a part of a team that grew a very fast-growing mortgage company. As you can see under the third bullet point, we did, the usual suspects in terms of products, but we did a lot of FHA. We also did the housing programs, DPA, MCC, bond, all that good stuff. We worked with some of the builder industry. So as you may know, that really kind of dovetailed us into FHA a lot. And that's initially where I made the connection with Cheryl Deal and how I got involved with Deal as well. I would also say that we really are supportive of state associations. A lot of times you'll hear of changes going on in the industry. And if you want to be active and you want to make a difference, which I think we all do, make sure that you spend some time and get involved with your state association. Be active with the MBA and MORPAC. That's really how you get your voice heard. And I know that we all don't want to be folks that are just hearing these changes. We'd like to be able to provide our input, and those are great ways to do it. I also want to introduce a member of our team that's actually been on our team for a while. She is not here on the webinar recording today. She's actually training FHA underwriting as we speak via webinar. But Marianne Collins leads the Ohio Mortgage Bankers Association. She's also been doing the VA underwriting training for us for the past few years, and also is doing FHA underwriting training. Marianne's got a very deep background with FHA and underwriting, processing, all the way up to starting the mortgage division of a bank. So a lot of ops experience that you can leverage if you're utilizing Deal. Just another member of our team. Wanted to do a quick intro to Marianne to you. I won't say anything much about this other than the fact that we're up to 40,000 in terms of the total people trained at Deal. And we'll spend a few minutes talking about what we're going to talk about here as we go into the material. One is we'll talk about an update of the fund. We'll talk about what FHA is looking at with reviewing lenders and what they really focus on. We'll dig into the current priorities, and then I'll also really go a little deeper and talk about some of the things that are really designed to help accomplish some of those current priorities. And we'll also finish up with a timeline of how all this is rolling out. We do have a copy, and I'm not sure on the recording if you can access it, but it would be in the materials tab where we just put a PDF version of the FHA handbook draft. You can also go to the FHA website and download it. We merely put it there as a convenience. So what we've learned recently is that the actual handbook is going to be released within the summer. So once we heard about that, we really wanted to focus our message today on the other parts of what's changing with FHA. We're literally a month or two out of seeing the handbook, and instead of talking about it in too much detail, we're really going to defer that until the handbook becomes available in its final form. I can tell you that Marianne was part of the team with the National MBA that reviewed the handbook, and the entire group provided feedback to FHA. It's a 300-page draft. There were 400 comments that the group came up with. So just to give you an idea, there's definitely a lot of industry feedback. That also kind of tells you that there's a lot going on in the new handbook draft. In other words, it's not something that industry just looks at and doesn't have any questions about. It's actually something that there were quite a few questions about. So let's dig into some FHA updates here. First of all, we have a variety of sources for this too. Just we attend conferences that are, sometimes the MBA, sometimes other industry groups, NMLS, ARMOR, various state banking associations. So we really try to put this into a package that helps you kind of get updated on what's going on, regardless of where it's being talked about. So the first thing you'll see on the screen is that a memorandum of understanding between FHA and CSBS was signed. And what that really means is that the loans are being validated down to the license of the MLO and the company to make sure that those NMLS numbers that are showing up on the loans indicate that the MLO and the company are properly licensed. So just a deeper dive and another kind of further quality step, if you will. The next thing is, and you've probably heard a lot about this, going back to last year, that the fund dipped below where FHA typically likes to see it. And as a result, we saw some credit policy changes. We also saw MI changes. And that, coupled with where the loan performance is right now, have led to a projection of 2015 to where the fund will be back where FHA likes it to be. So that's a very short version, obviously, in talking about that. EPDs, as you can see on your screen, are early payment defaults. Those are at a 7-year low. Home retention activities, as you might imagine, are on an upswing, and HAMP is a big part of that. Really, the MI fund being where it is a combination of factors. Home appreciation is another factor that's really strengthening the MI fund and the projected cash flows coming off of the FHA loans. Credit policy changes, MI changes also have played a part in that. So some interesting stats as far as what FHA is looking at with lenders. In 2013, FHA reviewed 20% of FHA lenders, and as you can see, that was 330 lender reviews. They looked at 1% of endorsements, 91% of EPDs, early payment defaults, 90% of non-performing loans that are in the 2-year short-term delinquency window or neighborhood watch window, and also reviewed 2/3 of files that were associated with lender self-reporting. That was a total of 40,000 loans and $334 million that FHA saved, which you could deduce that lenders may have paid as well. But you can see the focus as far as on a 2013 and backward look is really on a little bit on endorsements and a lot on any loans that had any problem issues. On a go-forward basis, FHA is talking about flattening that out a little bit. In other words, looking at more of a randomized approach to endorsements and not such a reliance on loans that have any issues, if you will. Current priorities are expanding access to credit, continuing to add to the viability of the fund, and also to streamline business processes with lenders to make it easier to do business with FHA. Expanding access is also a big part of that. So we're going to go into detail about a first-time homebuyer program. You may have heard of it. If you haven't, you want to pay particular attention to it. It's got some neat facets to it, the HAWK program. Also, the quality assurance framework is changing as well. We have talked about the handbook that's on its way, scheduled to be here within the summer. So pricing product for risk is part of ensuring that long-term viability. The thing that we are seeing right now, as you can imagine, the loans that are being written now are some of the best performing loans in history, and that's adding to the portfolio as the new loans that are coming in are performing very well and kind of balancing out the portfolio. So there's a couple things that we're going to go into some more detail that really fit into this making easier to do business with FHA category. We'll talk about EAD, we'll talk about LEAP, data standards, and also ongoing transformation. So we're going to take a little bit of a deep dive look at this to understand what's really driving some of these changes. If you look at 2007, before the crisis, this light blue band represents borrowers with greater than a 680 score, and it looks like it's about 15%, maybe 14% of the FHA loans were in that credit band of greater than 680. 640 to 680, you can see was somewhere 55 to 75, maybe 20% of the 2007 FHA loans. And then under 640, you've got the really vast majority of loans that were in that category, really serving borrowers with less than a 640. As you know, when we had the financial markets crash, FHA remained a lender that did not change a lot of their guidelines. It added stability to what was going on in the marketplace. It was certainly the best thing for everyone, from industry to borrowers, to have FHA remain a strong option. A byproduct of that was that even folks with the higher credit scores were accessing a lot of the FHA loans as well. Not a bad thing, an important thing back then. But now that we're in the recovery mode, that's where you really see things shifting. In 2011, it was even a greater percentage of the FHA loans with the highest credit scores. I'm sure you remember some of the files that were borrowers that had extremely high credit scores, but if they put enough money down, they were at least avoiding much of the MI and able to get a great product fairly quickly and easily with FHA. As you've seen us move into 2012 and 2013, that has shifted a little bit. You can also see that the 2013 numbers were probably impacted by changing MI, and the target really remains at the far right, and that's really what you see here at the far right, with the 680 scores being desired to be a smaller portion of that too. And we've got a little background noise here. If I could ask for a little help with that, I'd appreciate it. Thanks. Now, the second band you can see in the target, and then at the bottom is really where the target is for borrowers under a 640 score, and really, where we are at in 2013. So a pretty big change between those two. So this really is a great way to start talking about the lender supplemental performance metric, and we'll do so in just a moment. So what are some of the programs that are designed to help underserved borrowers? The HAWK program, really, in just my personal opinion, really sounds like an interesting program in that it really looks at how to help those underserved borrowers, and at the same time, if they're willing to do things to reduce their risk, allow them to achieve some savings on their MI. So HAWK stands for Homeowners Armed with Knowledge, and it is a program that's designed, at least in the way that it's being talked about right now, would allow first-time home buyers to complete counseling and then qualify for reduced MI. So it kind of makes sense. FHA looked at loan performance and realized that loan performance associated with borrowers that did counseling was better. Those loans perform better. So here's an opportunity for those borrowers to get some reduced MI if they do participate in that home ownership counseling. Quality assurance is also evolving, as we alluded to earlier, and essentially the idea is to provide more transparency to the lender about what's being measured, what's being looked at, in order for lenders to be able to make those changes. And some of what has been talked about is moving to more random sampling, and in other words, greater than 1% of the endorsed loans, and not just a focus on loans with any particular issues. So that really talks about loan sampling. And then the lender performance metric, which we'll talk about as well in more detail. We did mention the handbook coming in the summer. Additional sections: appraisal, 203K, condos, doing business with QA, QC, oversight, and compliance are in the process of being put together. I would tell you that the deadline for industry and other feedback for both the doing business with FHA and also the quality control sections is August 15th. So encourage you to go to the FHA website and make comments on those sections prior to the close of those feedback dates. Additional sections coming are listed on the screen as well. And the supplemental performance metric. Let me see if we can simplify what's on the screen. You're probably familiar, you may be familiar, maybe very familiar with the fact that FHA looks at the 2-year loan performance pretty carefully as it relates to Neighborhood Watch and really looking at how lenders' loan performance is going, so to speak. When we looked at those credit bands, what we've always heard lenders say, and this is what we talked about earlier when we said there's really a lot of these changes that have been called for, I think, by lenders for some time, and this is one of those. It's been a common topic, if you will, for lenders to say, yes, I've got this delinquency rate that I need to manage, but I also want to lend to all credit score bands. And I know that some of the lower credit score bands, those loans may not perform as well. So I may be being hurt if I'm trying to do what fits in line with FHA's mission of lending to underserved borrowers. That actually may hurt some of my numbers with FHA. And so that's the idea of this supplemental performance metric is an offset to the traditional Neighborhood Watch number. Now, how does this work? We just looked at these bands a minute ago in the table, and we talked about where lending was at. But you can see the FHA portfolio overall right now, the borrowers that are under a 640 score are only 9% of the FHA portfolio. These tables are sourced from FHA, which I want to make mention of as well. So 9% of the borrowers in the portfolio are under a 640 score. 38% of the borrowers in FHA's portfolio have a 640 to a 680. And then over here on the right, greater than 680 is actually 53% of the loans in the portfolio. Now, the short-term delinquency rates, i.e. the Neighborhood Watch number for those credit score bands are 2.6% for under 640, 1.5% for the 640 to 680, and 0.4% for the greater than 680. So the weighted short-term delinquency rates listed here. So the target that FHA would like to see, which is consistent with the graphs that we saw before, is to have about 25% of the portfolio under 640, about 50% kind of in this middle band, and then 25% over the 680 level. So here's an example of a lender. Let's say that this lender actually is kind of serving, kind of going for these targets and helping the portfolio get where FHA would like to see it be, or at least the target. And they're lending 30% of their loans to credit scores below a 640, but their short-term delinquency rate as a result of that is at a 2.9% level. In the middle here, there's 60% of their borrowers are at that 640 to 680 zone, and that Neighborhood Watch number, if you will, is 1.6%. And then over 680 is only 10% with a very low short-term delinquency rate. So what happens is this lender ends up with a Neighborhood Watch compare ratio of 187, but when you factor in the lender supplemental metric, they only end up at 118. So you can see these are the on a go-forward basis, this supplemental metric is designed to tell FHA and the lender more about really where they're lending. And our understanding is that the Neighborhood Watch is a statutory number that has to be calculated the way that it is. However, FHA can create the supplemental metric and look at both of these numbers when evaluating loan performance of a lender, and really kind of see this as an offset to this compare ratio that's listed here, the 187. So I think I think many people would agree that's some good news as well for FHA lenders, especially if you're serving some of those credit score bands. So the next thing that we're going to talk about is really a QA item, and in the past, FHA's had over 90 error codes for a loan. So if there's a loan that's having issues, there could be multiple reasons that are listed next to that loan that it's having those issues. And if you've got 4 or 5 or more reasons next to a loan, it really makes it difficult for a lender to tell what was really the triggering cause. And by slimming this down and having actually 9 defect codes, this could make the process more straightforward and streamlined. So you can see the proposed codes, all 9 of them listed on the left. And they're somewhat broad, and they actually map right back to the loan underwriting process. So this is, I think, will be, at least we're hearing from lenders, a welcome change in terms of moving from 90 to 9, and maybe being able to do some quicker diagnosis of any issues, and then communicate that information backward through the organization so that these areas can be looked at more closely. So the question that I had is what are there some other reasons under borrower income, for example, that are really the causes? And the response is that it's really going to be a hierarchy. In other words, one of these 9 codes, and then there can be additional error codes below that would give the lender more detail. But by defining it to 9, it makes it a little bit more simpler process to look at the whole QA process with loans that aren't performing. So we talked about things are improving, but still need to get a little bit more time under the belt, so to speak, in order to put the fund where FHA likes to see it. We talked about MIP aligned to better price for risk, and we know that loan performance is definitely in a good spot for loans that are being originated now. So the idea of this handbook is not only to update the handbook and put all the mortgagee letters and the handbook together into one source, but also to further define FHA so that it may not be so subject to interpretation depending on which area of the country that you're in, if you're familiar with that concept. So the idea is a single point of contact or a single authority on everything FHA that can really make understanding FHA simpler and easier across the board. As far as the business transformation pieces that you'll see on the screen, we'll talk a little bit about EAD. We'll talk about the second one. We love acronyms in our industry, so we'll call that LEAP, right? And then also industry data standards as well. So the long and short of EAD is it's really coming into line with the appraisal management that both Fannie and Freddie have implemented. So the benefits of Fannie and Freddie doing that have been to put more data, into a location where both Fannie and Freddie and lenders could access it, and they could look deeper into what's happening with loans that are performing and not performing, and share that information across the board. So that's really the short version of EAD. LEAP really has to do with your annual recertification. So if you're familiar with the IMF and LAS, then you'll know how those systems worked. This is really just a new system that really takes everything forward a few steps in terms of a new system to replace IMF and LAS. Now, the other thing is that there is more information going into the system, just like with the appraisal system. The idea is to be able to give FHA more information to understand lenders better. And the financial statement data is part of that you see listed here on the bullet point that's third from the bottom. The idea is that there could be some analysis of this submitted financial statement data that could be helpful and relevant to FHA as it continues to move forward as an organization. So when is all this happening? HAWK is to be published in the Federal Register, and also kind of putting together the mortgagee letter and then a final notice on it. The QA framework is in development as well. The handbook slated for summer, and you can see the additional sections here that are being posted for feedback: appraiser, condominiums, and 203K. Remember that the feedback period's closing for doing business with FHA and QC, both on August 15th. We talked about the publishing of the handbook, application through endorsement section in the summer, and then as we shift into fall, the pilot project of the HAWK program being implemented and taking effect, the QA framework and a preview of what the taxonomy will look like, in other words, the new codes and how that will all work, as well as additional sections of the FHA handbook for servicing and loss mitigation. So I'll flip through. I think we've pretty much covered this. I did this quick recording for everybody. So if you missed out, hopefully this was helpful to you. We designed this to be kind of a quick hits to keep you in the loop on what's changing. And we certainly want to say thank you for joining us with the recording today. And if we can be of help to you, please don't hesitate to reach out. We'll certainly have, as soon as the handbook is announced, an informational webinar on the handbook and also some deeper dive trainings designed for underwriting and processing as well. But we do want to say thank you. We appreciate the relationship we've had with you, and we look forward to talking to you more in the future. So we wish you a great day or a great weekend, depending on when you're listening to this. And thanks again for joining us today.